You're running full speed, but the markets are faster. Quasar Markets Live brings the world's top financial minds to you. Everything you need to know in one person, gain a competitive edge, leveling the playing field for you. Join the conversation. Quasar Markets Live.
All right, everybody. Quasar Markets Live here. Dr. ELLMAN's with me. You all know him as Mr. Options himself. He's going to show you again how to make your portfolio work for you. And I'm excited about today. How are you, Alan?
Doing great. Thanks, Steve.
All right, I'm going to turn it right over to you because I know this is exciting stuff. So I'm going to let you have it right now. I'm going to actually put your screens up right now.
Appreciate it. Welcome, everybody. The topic I'm going to discuss today, I feel, will apply to many of you from Quasar, perhaps even most of you. And it's a way of generating additional income in your long-term buy and hold portfolios using a strategy known as portfolio overwriting, which is a form of covered call writing. Now, when you own stocks for the long haul, most of the time, these stocks are of a very low cost basis. Now, if you're trading in non-sheltered accounts and your shares are sold, there could be some negative capital gains tax issues, which you want to avoid. So when you're looking to generate a third income stream in these portfolios, we also want to make sure that in addition to selling options or renting out the shares, we don't want our shares sold. In other words, we want our cake and eat it too. So for those of you who have owned shares for quite a long period of time and have had some appreciation of those shares, and certainly that's put a smile on your face, and also many of these shares have also been generating dividend income, so two income streams. Many of you absolutely can generate a third income stream by taking advantage of selling options, leveraging those very same shares. And this is a strategy known as covered call writing, but more specifically, portfolio overwriting when you don't want your shares sold. In essence, what we're doing is renting out our shares for short periods of time, a week or a month, something like that. And in return, we get rental income or option premium. So let me review first with you what is covered call writing. That's the main strategy. Then we'll focus in on a covered call writing like strategy, portfolio overwriting. So let's break down the three words in the term covered call writing. Covered means we buy the stock first. In other words, we are protected because we know our cost basis. When we sell a call option, we're agreeing to own the shares, to sell our shares at a price that we determine, which is called the strike price, by a date that we determine, which is known as the expiration date. So by knowing our cost basis, we are covered or protected. Now, call is the type of option that we're selling. Once again, we have a contractual obligation to sell our shares at the strike price by the expiration date. But remember now, we want to collect that premium, but we don't want our shares sold. And I'm going to show you how to do that where you have much less than even a 1% chance of having your shares taken away from you. And we'll keep that premium income flowing in. And that's the third step. You know, we buy the stock, we sell the option, we collect the premium. Now, when we're doing traditional covered call writing, my goal is 2 to 4% a month. But with this particular strategy related to covered call writing, portfolio overwriting, we're going to set our strike prices, or the prices we're agreeing to sell our shares for, much, much higher than current market value, which means the possibility of getting our shares sold is very, very small. So therefore, the premium we collect will be much lower. My goal with portfolio overwriting on an annualized basis is an additional, underline that word additional, 4 to 10% a year over and above what we've been getting all along on share appreciation and dividend income. Now, once we enter our trades, we go into position management because there may be some exit strategy opportunities. That aspect is beyond the scope of this presentation. So let's now define this type of covered call writing known as portfolio overwriting. We're looking to enhance the returns of our long-term buy and hold portfolio. Perhaps shares we've owned for years, maybe even decades, but we can leverage those shares for a third income stream. Now, we also want to avoid exercise of those options, which means having our shares sold and perhaps end up with some negative capital gains consequences. So this strategy applies to non-sheltered accounts because in an IRA, there would be no tax consequences at that point in time. Now, our goal, well, we want to increase our annualized returns with this portfolio by 4 to 10% a year. Singles and doubles, no grand slam home runs. And this is a very reasonable example, as you're going to see in just a moment. And that would translate into about 0.5% a month if you're doing monthly options, or 0.12% a week if you're doing weekly options. I do both. I do weeklies and monthlies on both calls and puts. Today we're talking about calls, covered call writing, specifically portfolio overwriting. Now we're going to use only deep out of the money call strikes. In other words, agreeing to sell our shares at a much, much higher price than it's currently trading for. Now, for those of you familiar with the option Greeks, that means low delta strike prices. In other words, delta meaning the approximate probability of being subject to exercise, meaning the price of the stock going from where it is today to above that very deep out of the money call strike. What is the probability of that? Well, delta will tell you that. So if you use a delta of 10 on your call strike, that means there's only a 10% probability of that strike being subject to exercise, the price of the stock moving so much higher that it goes over and above that deep out of the money call strike. Well, Alan, you just said less than 1%. Now you're saying 10%. Well, the reason I'm saying that is because even if that happens and the price of the stock does in fact go way up and above that deep out of the money call strike, we can always buy back that option at any time before 4 p.m. Eastern time on expiration Friday. Okay, now there are two key dates that you must avoid. Number one, earnings dates, because earnings create volatility. If a stock has an earnings report that blows the roof off of consensus, that stock can go up in price substantially, blowing way past that deep out of the money call strike. So we don't want to have an option in place when there's an upcoming earnings report. The other date you want to avoid is the ex-dividend date, because that's the main reason for early exercise of our options. So keep that in mind. The two dates to avoid with portfolio overwriting are earnings dates and ex-dividend dates. So how do we know which strike to select? Well, you could do it based on returns. We talked about that before. We said 0.5% a month or 0.12% a week is a reasonable. But we must identify our goals up front. Otherwise, how are we going to know what strike to select? Now, we're only going to use out of the money strikes, right? Because if we use an in the money strike, agreeing to sell our shares at a lower price than current market value, those strikes have a very high delta and a high probability of expiring in the money and therefore subject to exercise. So only out of the money, but not just out of the money, deep out of the money, way higher than current market value. Now, I'm going to show you how you can use delta and implied volatility to quantify the risk of exercise and also to determine whether or not that will then meet our pre-stated initial time value return goal range. Okay, we must stay focused on what our goals are. Keep the shares and 4 to 10% annualized returns. I'm going to select NVIDIA as an example now. At the time that I made this screenshot, it was only a couple days ago, on the 18th of July 25, NVIDIA was trading at 172.28, and notice it's for the August 15th 25 expiration, so a little bit less than a month out. Now, I highlighted for you in color some of the key things to look at in this option chain. First of all, we want to look at the implied volatility of the near the money 170 strike. This 170 is closest to current market value, 172.28. So if we look at the implied volatility, it's 35%. in a couple of slides, we're going to use that to determine a trading range, and I'll show you why that would represent a strike price with a 16% risk of exercise. So implied volatility is one thing we're going to look at. We'll talk about that on the next slide. Now, the other thing I want you to look at is the delta. Remember, I told you that's the approximate probability of expiring in the money and therefore subject to exercise. What kind of risk are we willing to take? Not counting exit strategies where we can always buy back the option. Well, how about 10%? That's very reasonable for portfolio overwriting. 90% chance that it won't expire in the money and subject to exercise means that nothing, we don't have to do anything, just let it expire. Well, that would be the 95 strike, 195 strike, which had a bid price. We're going to calculate this for you in a little bit, of 74 cents a share. A little more risk, 16% delta with the 190 strike, and that would generate $1.26. So keep those things in mind. The at the money implied volatility is 35%. The 10 delta has a 195 strike. The 16 delta has a 190 strike, and the bid price is 74 cents and $1.26. Now, I want to talk to you in the next two slides about implied volatility. You probably know about implied volatility, but not everything. Most retail investors don't know everything about the implied volatility stats that they get from an option chain. So the definition, general definition, it's a forecast of the underlying stock or exchange traded funds volatility as projected by the option pricing in the marketplace over 30 days. Now, what some retail investors may not know is that this implied volatility stat, let's say it's 35%, as it is with NVIDIA, well, that means it's expected to go up or down by 35%, but not for that particular contract, over the next 1 year. So we have to use a conversion formula to get it specific for that contract, and I developed a spreadsheet for that, which I'll show you in this presentation. Also, what some retail investors might not know is that IV is based on one standard deviation, which means it's expected to fall into that range, up or down 35%, 68% at a time, which means that it's not going to fall in that range 32% at a time. So why am I going to tell you that the risk factor of expiring out of the money is only 16%? Well, that's coming up in the next slide. So there's an 84% probability of success, not non-exercise, using implied volatility. Okay, let me show you why it's 16 and not 32. You may remember back from high school or college, the standard bell curve, and you could see in the middle, in the dark field, is your 68% one standard deviation. So it's going to fall outside of that range 32% at a time. But of that 32% at a time, 16% is on the low end. That won't hurt us. Our shares will not be exercised unless the price of the stock goes up more than that deep out of the money call strike. So the risk factor is the red broken arrow on the top right, 16%. So we have an 84% probability of success without exit strategies using IV, and I'm going to show you that in the upcoming slide, to determine a trading range. So this is the spreadsheet that my team and I developed for the expected price movement using implied volatility. It's very easy. All you do is put in the ticker symbol of the security, the current date, the expiration date, the current price, and the implied volatility of the near the money strike. That's all you have to do. Spreadsheet tells us the following. If taken through contract expiration, it's a 29-day trade, and NVIDIA is expected to go up during that period of time, $17 up or down, which will give us then a trading range from 155.28 on the low end to 189.28 on the high end. So we would then select the 190 strike, which would give us a 16% risk factor. If you recall from the option chain before, that also was the 190 strike was also the 16 delta. So that kind of aligned perfectly. All right, so let's take a look at the two strikes that we talked about. The 190 strike, which has both the 16 delta and based on the implied volatility trading range, which had a bid price of $1.26, and the 195, which had the delta of 10, which had a bid price of 74. We would expect the higher strike to give lower returns, and you could see that with the two bid prices. So let's now see what the trade management calculator spreadsheet showed you that in previous discussions with Quasar. And that tells us the following. The oval in red here tells us if taken through contract expiration, it's a 29-day trade. You also saw that on the expected price movement calculator spreadsheet. Now, in the brown cells, you have your return for the 190 strike, and that's the 16 delta and the implied volatility. That gives us a return of 0.73%, and based on a 29-day trade, annualizes out to 9.21%. What was our goal? 4 to 10%. That's the high end. Also, you can see in the purple cell that if NVIDIA moves from 172.28 up to or beyond the 190 strike, well, we also have an opportunity to capture another 10% plus from share appreciation. So about an 11% max return with that trade. Now, if we look at the 195 deeper out of the money call strike, that will give us a lower return of 74 cents a share or 0.43%. And that's on a 29-day trade. And that annualizes out to 5.41% to the low end of our 4 to 10% annualized goal. We also have an opportunity to capture an additional 13+% from share appreciation if NVIDIA moves from 172.28 up to or beyond the deep out of the money 195 call strike. So, Steve, let me summarize for your members now. Portfolio overwriting is a form of covered call writing, and it's a low-risk way of enhancing portfolio value. In non-sheltered accounts, we want to avoid exercise because that may result in some negative capital gains tax issues. So we have to make sure to set the strike price as high as possible and yet achieve the goals we're seeking. In this case, I use 4 to 10% annualized. Dividend distribution, more specifically ex-dividend dates, is the main reason for early exercise. We must avoid those dates. Never have an option in place, just skip over it. If the stock has, or the ETF has weeklies, just skip that week. All right. Also avoid earnings dates, very volatile, and the price of the stock can blow through that deep out of the money call strike. You can quantify the risk of exercise using delta and implied volatility. Now, you must identify what your goal is before you enter a trade. Otherwise, how are you going to know which strike to select? So two things. You want to minimize your risk of exercise, and you want to make sure you have reasonable goals, and you can achieve those goals with that particular deep out of the money call strike. Now, once again, let me reiterate, Steve, for your members, that if a strike is expiring in the money, as unlikely as that is based on how we do this, we can always buy back the option prior to 4 p.m. Eastern Time on expiration Friday. Ladies and gentlemen, that ends this presentation of portfolio overwriting, covered call writing, our long-term buy and hold portfolios. Ladies and gentlemen, I hope you enjoyed this presentation. If you have any questions, you could feel free to email me directly at alan@thebluecollarinvestor.com. I answer all of my emails. Steve, thank you very much for inviting me to do this presentation. I look forward to doing many more with you.
Yeah, Alan. I mean, look, I think a lot of people really only think of options as one-sided. You can buy or sell them, and there's a whole different strategy behind them. And I think a lot of people don't really realize that. And I'm really appreciative of you showing us the new strategies that will bring, actual. When we're not playing zero DTEs here, right, Alan? We're actually showing people how to actually make money out of playing options, based on sometimes even the amount that you have in your actual portfolio. So it's not even like you're actually having to stick your neck out there. So I love it. Alan, we'll see you right back here in a few weeks.
Nice talking to you, Steve. Take care.